Hello, welcome listeners and market participants to KBRA's European Credit Podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today I am joined by Asha Drobnik from our Financial Institutions Ratings team.
Hello, everyone.
Ken Egan from our Sovereign Ratings team.
Hi, everyone.
And Kali Sirugudi from our Residential Mortgage-Backed Securities team.
Hello.
Today, we will be covering the topic of building societies, a prominent sector in the UK at the moment. We recently published our annual report on the sector titled Resilient Financial Profiles Amid Ongoing Challenges. Have a read of the paper. It covers a lot of topics facing the sector. You can find it online at kbra.com. Overall, KBRA believes the creditworthiness of UK building society sector remains resilient despite continuing challenges related to Brexit, the post-pandemic recovery, elevated inflation, and Russia's invasion of Ukraine, all of which weigh on the UK economy still. Headwinds in the housing market, as noted in our previous report, will continue to present challenges to the UK building societies. However, most are well prepared and should weather the storm with strong credit profiles. We have an interesting conversation on the topic lined up today to explain why. Ken, let's start with you. What do you see as the main economic challenges facing the UK, and how do these relate to the building societies?
Thanks, Gordon. So just a reminder, the UK, which KBRA currently rates as AA with a stable outlook, is a large, wealthy, resilient, and diversified economy. The country has high-quality institutions and strong governance factors, although some metrics have been challenged recently.
Agreed. The current inflationary environment poses challenges to the economy, as it has been in many other economies recently. However, many of them have outperformed expectations so far. How is this inflationary pressure more pronounced in the UK compared to peers?
So the prospect of elevated and persistent inflation in the UK remains a concern both from a sovereign perspective and a general economic one. With regards to the topic at hand, building societies, they are particularly exposed to the impacts of inflation on their borrowers and its influence on interest rate decisions. Price growth has slowed considerably over the last year, which is encouraging. The latest reading as of this podcast showed that year over year, UK inflation fell to 3.2% in March, but this price growth persists at a higher level than the Eurozone at 2.6%. The overwhelming contributor to inflation was initially high energy prices, while supply chain dislocations also placed upward pressure on goods prices. These have moderated, but services price growth, which was still growing at 6% in March, indicates some stickiness. And this is currently more pronounced than in the US or the Euro area. That said, these economies are experiencing a similar trend as services price growth currently represents the primary driver of inflation. In the UK, Brexit has added to certain underlying pressures for domestic inflation, particularly within core goods and the labour market, as it raises the cost of doing business. Brexit constricted the economy's openness, so prices have greater elasticity to supply and demand. As a result, expectations of inflation are higher in the UK than they will be in the US or the Eurozone.
Okay, so what does this mean for the economy going forwards then?
Yeah, so over the short and medium-term horizon, the UK is expected to grow at a more subdued rate. Tighter monetary policy conditions, which depress economic activity, coupled with sticky inflation, could weigh on consumption-led growth. And what I mean is this environment is impacting real household disposable income. So both growth channels, consumption and investment, could remain weak. Although some official expectations for the UK economy have improved, many still anticipate a prolonged period of relatively weak growth. The unemployment rate currently stands at 4.2%, and while we have seen an uptick in this metric, it still indicates a significantly tight labour market, which stems from supply-side challenges similar to many advanced economies globally. The pandemic and Brexit have together reduced UK labour market supply, while the drop in migration of skilled workers from the EU has distorted labour dynamics in certain sectors, such as construction, hospitality, and manufacturing. A topic I believe you and I will be covering on a future podcast.
Yes, we will. Listeners, watch out for that one.
So the real crux in terms of a focus on building societies is that interest rate increases will negatively impact UK household budgets, although the rise of real wages will help offset this somewhat. There is an increasing disparity of income between the rich and the less affluent in the UK, while household incomes have not risen as much as their European counterparts. Increased unemployment would elevate household stress and could pressure mortgage portfolios. However, household savings built up over the pandemic, fiscal support, and strong employment levels have enabled households to weather the increased stresses to date.
Many thanks for that, Ken. So we have a challenging backdrop facing the UK building society sector, Asha. We highlighted that this challenging environment was coming in our report in 2023, which you can find on our website, but it hasn't quite materialized in the way that many expected. Anyway, KBRA recently attended the annual UK Building Society event. How was the mood there? Was there anything to note other than the concerning prospects for future house price growth?
Yes, we did attend the Building Society's annual event held in Manchester this year. There was a train strike, but it only partially impacted attendance, as many of the members were happy to make alternative travel plans. Overall, it was a well-organized and constructive conference as usual. The mood overall was optimistic, but there was a lot of discussions around challenges ahead, especially on the digital front, but also around regulatory pressures and climate change. There were several interesting speakers and panels, including data-driven evolution, futures of savings, mutuals collaboration on technology, impact of climate change on risk management, and green housing.
Thanks, Asha. So I will come back to you on how the building societies are doing overall. But first, for our listeners that don't know what they are, do you mind giving our listeners a quick outline on what exactly a building society is?
Sure. Building societies are mutual institutions owned by and working on behalf of their customers. So they typically aim to focus on long-term sustainability. The societies have a long and important history of providing savings and mortgages across the UK, traditionally offering better interest rates. They play a crucial role in the UK economy, representing nearly a quarter of outstanding residential mortgages. The societies also play an active role in local communities, and many have established charitable foundations or community funds to support causes important to their members and employees. One defining feature of UK building societies is that at least 75% of their lending, by law, must be fully secure on residential properties. In addition, a minimum of 50% of their funds are required to be funded from retail deposits. These two features restrict the ability of building societies to diversify their models, but make them inherently focus on helping their members to save for and buy a home.
Thanks, Asha. Now that you've mentioned the focus on residential mortgages, I'd like to bring in our residential mortgage expert, Kali. Kali, what are you seeing as the major features of the current UK housing market?
Thanks, Gordon. While I'm an expert at analyzing residential mortgage portfolios, I'm not a broker. So don't ask me for advice on how much you can or should borrow.
Don't worry, I'm all set on that front.
Anyway, if we consider what we have seen over the past several years with the Bank of England interest rate hikes through 2022-23, these have increased mortgage costs, weakened affordability for house purchases, which Ken alluded to earlier. This has resulted in a housing market slowdown, with house prices declining roughly 5% at the national level from their peak in the third quarter of 2022, according to the nationwide house price index. February 2024 saw a small recovery in house prices as mortgage rates temporarily declined. Now, since their peak, house prices have declined in all regions in the UK, ranging from 2 to 8%. Southwest, East Anglia, and Southeast showed the steepest decline so far, with house prices falling in excess of 7.5%. However, most of the regional house price movement in the first quarter of this year shows a slight recovery in house prices, driven by the declining mortgage rates. And despite the small surge in demand for house purchases, the broader market remains impacted by affordability challenges and contracting demand for house purchases. To highlight this, the number of property transactions fell year over year in February 2024. They are up slightly from January levels, but overall remain a marked step down of 36% versus September 2022 levels and below the monthly average since the beginning of the pandemic.
Thanks for that. And what do you expect going forward out of the housing market?
So I do not expect house purchase demand to revive at the current high mortgage rates. First-time buyers are adversely affected by the loan amount they are eligible to obtain with a higher deposit requirement. A reprieve could come from a strong indication of rate cuts, changing buyer sentiment, and payment affordability. At the moment, changing expectation of rate cuts has meant volatility in mortgage rates, making it difficult for people to make decisions on affordability and commitment to purchase. On the positive side, the UK housing market should remain supported by the country's perennial low housing supply with regular below target house building, meaning that any potential for further declines is likely to be tempered. We're certainly seeing currently a period of uncertainty for house purchase.
Many thanks for that, Kali. What about performance? You mentioned affordability challenges. What impact is this having on borrowers in the housing market?
The mortgage delinquencies show a sustained increasing trend, but remain much lower than the worst post-GFC levels. Repossessions have increased over the last 12 months after the pandemic lows, but remain at the lower end of historical levels. So we expect delinquencies and repossessions to rise further as borrowers continue to deal with the elevated rates and as inflation continues to impact household expenditure. Self-employed borrowers with income volatility, those on variable interest rates, and borrowers categorized as vulnerable are likely to continue to struggle in 2024 and 25. The quantum of any increase in delinquencies and/or default is essentially contingent on employment and UK borrowers' resilience to persistent high inflation and energy prices. Increased costs can squeeze the disposable income of borrowers, particularly those on the edge of affordability and those with high leverage. Further to this, a meaningful proportion of those mortgages needing to remortgage at the end of their teaser period will face a payment shock at higher fixed and variable rates. On the positive side, UK unemployment levels currently remain low, preventing many borrowers from falling into significant arrears. Borrowers can also expect support from lenders who have committed to the mortgage charter announced by the UK government in June 2023. About 90% of lenders in the UK mortgage market have committed to the charter to date. The commitments under the charter do not apply to buy-to-let mortgages, but they require lenders to owner-occupied borrowers to offer options that fall into arrears other than repossession. Options include a temporary reduction in payments through switching to interest only or an extension of loan term.
Many thanks for that, Kali. Now, turning our attention back to the building societies themselves, Asha, there's the backdrop that societies face: potential for slower growth, ongoing inflation, lower house prices, and stretched borrowers. This is not all that pretty, but also sort of as we predicted a year ago. Yet, how prepared are they for this type of environment?
KBRA believes that the sector can absorb continuing macro pressures. Forthcoming challenges and risks to UK building societies' profitability and asset quality are mitigated by their generally sound capitalization, ample liquidity, and stable funding. In addition, societies' typically conservative loan-to-value ratios and performing mortgage books should also help to mitigate loan losses. Earnings will likely keep benefiting from higher interest rates in the coming quarters, but we expect increased loan impairment charges and the ongoing slowdown in mortgage lending to pressure profitability.
I agree. The societies continue to face headwinds, but still seem to be well prepared with their conservative approaches to weather any sort of deterioration in economic conditions. Let's dig a bit deeper into this, though. What is the impact of higher rates for longer on building societies?
While for borrowers, higher rates are a problem, they are positive for banks and building societies. KBRA's calculated average net interest margin for the sector increased to 1.8% last year, reflecting the higher interest rate environment and reaching levels not seen after the GFC. That said, for most societies, expansion of margins was smaller compared to the prior year, and Leeds Building Society even reported margin compression. This reflected a higher pass-through of base rate hikes to savers and narrowing mortgage spreads. We think that the net interest margins are likely to have peaked in 2023 due to competitive pressure for mortgages and deposits. Notably, wholesale funding is being refinanced at higher rates, particularly given the prior usage of cheap government funding schemes.
So what does all this mean for profitability?
Building societies' profitability remains above its prior peak in 2014-15, although it declined in 2023, with KBRA's calculated average return on assets at 0.5%. Sector performance last year reflected a further improvement in net interest margins, rising operating expenses, normalization of impairments, and for some societies, losses or significantly lower income from fair value movements in derivatives used to manage interest risks. Large societies continue to report the strongest profitability across the sector, underpinned by strong regional franchises and right-sized operations to leverage their cost base. Given the lack of revenue diversification, the society's profitability heavily depends on their ability to grow mortgage books, but we expect further loan growth to continue to be impacted by the significantly higher interest rate environment and consumer affordability pressures that contribute to subdued housing market, as outlined by Kali. We feel that the sector's profitability will likely weaken in 2024, driven by increased mortgage market competition, higher funding costs, and continued normalization of loan impairment charges.
One last question, one of particular interest given what happened last year in the United States to the smaller regional banks like Silicon Valley Bank. How well supported are the building societies in terms of funding and capitalization?
Oh yes, a very important question to finish on. Capitalization in the sector is sound on both a risk-weighted and non-risk-weighted basis, with KBRA's calculated average fully loaded common equity Tier 1 ratio at 20% and leverage ratio at 6% in 2023. Maintaining strong capital with solid buffers above minimum regulatory requirements is crucial for the sector. This is because of the society's mutual status, which limits their access to external capital. Capitalization at large building societies, which focus on low-risk prime residential mortgages, is strong considering their risk profiles. However, smaller societies with below-average capital and leverage ratios have weaker risk-adjusted capitalization, making them more susceptible to weaker economic conditions and/or sector-specific problems. However, they are currently not challenged by this. In terms of funding, these are sound throughout the sector, with nearly 80% of aggregated total funding composed of stable retail customer deposits. This is supplemented, in case of larger societies, by generally good access to the long-term wholesale debt markets. Societies have previously utilized successive government funding schemes, but the closure of the last one in October 2021 and the higher interest environment are gradually translating into higher funding costs for building societies. While these increased costs are manageable for larger building societies, they could prove a challenge for smaller institutions, given no access to the wholesale debt markets. Nonetheless, most building societies have sound liquidity profiles, with KBRA's calculated average liquidity ratio of 210% in 2023, supported by a large stock of liquid assets comprising mainly cash and high-quality sovereign exposures. This is complemented by access to contingent liquidity sources from the Bank of England.
Many thanks for that, Asha, Ken, and Kali. That was a very interesting conversation. From inflation to house prices to profitability, we've covered it all. In summary, KBRA believes the UK building societies sector credit profile, particularly for the large and better performing mid-size or small societies, has notably resilient characteristics. The sector's modest profitability, although supported by a higher interest rate environment, is expected to be pressured by higher loan impairments and a continuing slowdown in mortgage lending. Asset quality does remain strong, but as my colleagues outlined, we expect it to continue to deteriorate over the coming quarters as higher interest rates and inflationary pressures continue to feed through to the economy and into customer affordability. Overall, the sector's conservative loan-to-values and supportive credit profiles should help to mitigate any potential loan losses. That's it from us today. As always, we hope these conversations in credit help to illuminate the many trends taking shape across the markets. For more in-depth coverage of the themes discussed today, or to learn more about our unique approach to credit, sign up to the KBRA website and read all of our research. Have a topic idea or comment you'd like to share, or if you feel inspired for a discussion based on the conversation you just heard, reach out to me or one of the KBRA analysts on today's episode. Be sure to rate, share, and subscribe to the podcast so you can be notified when new content is available. Invite your colleagues as well. We'd love to count you all as informed listeners. This is Gordon Kerr, thanking you for being part of the conversation. Take care, everyone.